Will we see Disney revenues and earnings falling short of analysts' expectations? Earnings coming in at $1.35 adjusted versus estimates of $1.75. There are a couple of interesting items in here, many of them from the integration with Fox that seem to be behind that miss in EPS. Revenues also missing estimates, coming at $20.25 billion versus estimates of $21.47 billion. Bob Iger in his statement here is saying that the results reflect the efforts to effectively integrate the 21st Century Fox assets. And looking at what is behind those lower than expected numbers, studio entertainment operating income coming in lower than expected at $792 million versus the $1 billion expected, and that is because of Dark Phoenix. This is the 21st Century Fox film. The company here is saying that it recorded a film cost impairment because of Dark Phoenix, which was a big disappointment at the box office. Another factor here weighing on these results, the company says the direct-to-consumer and international division, that division showing lower, a larger loss than expected, operating income loss of $553 million in the quarter. The company is saying that the increase in operating loss at the direct-to-consumer and international division was due to the consolidation of Hulu, the ramp-up of investment in ESPN Plus, which was launched in April 2018, and costs associated with the upcoming launch of Disney Plus. We see Disney shares are now down nearly 5% in after-hours trading. Just to go into some of these other divisions here, parks and resorts, the revenues increased 7%. In the quarter at Parks and Resorts, right in line with expectations, but operating income for Parks and Resorts also lower than expected. Guys, back over to you.
Julia, thanks very much for that. The shares sliding quite significantly, down 4.5%. Mike, media networks, the significant miss, and also, of course, studio and entertainment. Yeah. Parks solid and direct-to-consumer a little ahead, but this is a surprise. EPS
a bit of a surprise. It seems like a little bit of a cleanup quarter with a lot of these items, as Julie was saying. In the studio, you take an impairment charge from an acquired film, and it does seem. First of all, again, we always have to remind Disney doesn't give guidance, so sometimes there's a little bit of play, but it's without a doubt a disappointment. I think that the investors had gotten, first of all, very focused on the long-term story, believing that the strategy is right in terms of direct-to-consumer, and also that the studio was just incredibly reliable. So I do think you had a little bit of that premium in there for the stability that got a little, defied by these numbers. But just a little bit of that premium being taken out is the way I would interpret the first trade here.
Paul Hickey, your first take on Disney?
Well, we sent out a report to clients this afternoon saying the August quarter is historically the weakest quarter in terms of stock price reaction. 10 out of the last 11 August quarterly reports, the stock has gapped down following the report. This will make it 11 out of 12. But I think for the longer term, I wouldn't worry too much about it. The story with Disney is the streaming service launching later on. So, I mean, investors who are bullish on the name could use this as a buying opportunity. The stock's done great over the last several years, but August quarter has historically been the worst quarter as far as the stock performance in reaction to those earnings reports.